Welcome to the Explainer. So, what if I told you the world's most famous beverage company doesn't actually want to bottle beverages? Today, we are going to unpack what Wall Street analysts call Coca-Cola's concentrate money printer. We're diving right into their exact 2025 financial data to dismantle the illusion of the simple soda manufacturer and show you the brilliant asset-light machine humming underneath.
Okay, here's our roadmap for today. First, we'll uncover the beverage illusion. Then, we'll map out the concentrate model in Layer 1, expose their 2025 financial mechanics in Layer 2, evaluate their intrinsic moat in Layer 3, and finally, look at the biggest global risks they face.
All right, let's jump right into Section 1, the beverage illusion.
Most people look at a bottle of Coke and see water, plastic packaging, logistics, local shelf service, right? The heavy, physical stuff. And sure, those are necessary, but they aren't the highest return parts of the system. The real goldmine, the hidden business, is the brand, the secret formula, the global marketing, and the concentrate itself. Think of it less like a traditional beverage and way more like a software license or printer ink. Coca-Cola doesn't need to own every single factory or delivery route to monetize global beverage consumption. They just sell the incredibly high-margin intellectual property.
And that brings us to the concentrate model. It's basically a system that separates the economics of the brand from the physical burden of distribution. So Coca-Cola sells the high-value invisible part of the drink and lets their bottling partners handle the heavy, visible part. By relying on these independent bottlers, the parent company keeps the lucrative brand economics for itself while pushing the expensive, physical execution out to the system. It is literally a masterclass in separating value creation from physical labor.
Moving right along to Layer 1, the concentrate model and bottling ecosystem.
Let's trace how a single dollar actually flows here through a strict division of labor. Step 1. Coca-Cola, the parent company, owns the trademark, protects the formula, and sells the highly concentrated syrup. That's it. Step 2. An independent bottler takes that syrup, adds the local water, the sweeteners, the carbonation, and puts it in a can or bottle. And Step 3. That same bottler drives it to the local supermarket. Coca-Cola is essentially collecting a high-margin toll while the bottler moves the heavy liquid.
And these independent bottling partners, they take on an immense physical operation and a truly staggering share of the capital intensity. I mean, it's incredible when you look at the sheer scale of what they handle. We're talking local manufacturing plants, buying the plastic and aluminum, warehousing, running massive fleets of trucks, and employing local labor to fill the store coolers. They carry the local working capital. This means Coca-Cola stays incredibly asset-light at the parent level, even though the overall system is intensely physical.
So here's your main takeaway for Layer 1. Coca-Cola doesn't need to ship water everywhere to make money from drinks everywhere. That is absolutely the best shortcut to understanding this company. They provide the flavor and the IP, while a global network of partners handles the immense local friction of actually moving that liquid around the planet.
Okay, let's look at Layer 2, the 2025 financial mechanics.
Check out this number, 61.6%. That is their 2025 gross profit margin. Traditional heavy beverage manufacturers literally cannot achieve this. A 61.6% margin is the absolute clearest sign of the concentrate model at work. Because Coke is predominantly selling high-value proprietary syrup instead of heavy finished bottles with expensive freight costs, their gross margins look way more like a tech or licensing company than a traditional manufacturer.
And that massive margin sits on top of $47.941 billion in 2025 net operating revenues, which, by the way, drove an operating income of over $13.7 billion. Now keep in mind, this revenue number isn't the total retail sales of every single Coke sold globally. That number is vastly larger. This $47.9 billion is just Coca-Cola's reported revenue. It's their high-margin slice of the global system. They extract incredible operating profit by letting the system bear the physical costs.
When we break down that 2025 revenue, you really see the financial core. 59% comes from concentrate operations and 41% from finished product operations. Yes, Coca-Cola does still own and run some physical bottling in specific markets, but the real engine, the true core of their profitability, is that 59% coming directly from the concentrate operations. But here is where it gets crazy. Look at the 2025 unit case volume split. That 59% of revenue, it drives 85% of the actual physical volume out in the world. Concentrate operations handled 85% of the unit cases, while the finished product operations handled just 15%. In 2025, the system sold 33.8 billion unit cases, and the parent company only directly handled the physical product for a fraction of that. This just completely proves the immense operating leverage they have.
So, to wrap up Layer 2, a 61.6% gross margin, concentrate making up 59% of revenue but driving 85% of the volume. And the ultimate result? A mountain of cash. In 2025, this asset-light framework converted into over $5.2 billion in reported free cash flow. It's a highly resilient cash generation machine.
Now we advance to Layer 3, Intrinsic Value and Moat. Let's see what keeps competitors from just copying this.
You see, Coca-Cola doesn't just sell beverages. They own occasions. We are talking 2.2 billion daily servings across more than 200 countries. People don't hold a committee meeting before buying a Coke at a gas station or a baseball game. It's an automatic daily habit. At 2.2 billion servings a day, the brand is just woven into global daily life. That high-frequency, low-ticket reality is an incredibly deep moat.
And they actively manage how they grow that revenue. In 2025, strategic price and mix management had a 4% favorable impact on revenues. Because they're a mature business, they can't just rely on selling more volume forever. Instead, they push premium packs, small packs, like those highly profitable mini cans, and shift their channel focus. It's a really delicate balancing act to raise the profitability of each transaction without breaking that daily consumer habit. Plus, they earned $2.031 billion in 2025 through bottler equity income. This is a super vital nuance. The parent company is asset-light, sure, but they aren't totally detached. They hold strategic equity stakes in some of their largest bottling partners, meaning they have skin in the game. It ensures they align their concentrate pricing with the actual financial health of the bottlers. The whole system only works if the bottlers are also making money.
When you combine all of this, the true scale of the moat is undeniable. Just 5 massive independent bottling partners handled 44% of global volume in 2025. This interconnected web of the brand, disciplined pricing, and localized distribution is nearly impossible for a new competitor to replicate from scratch.
All right, finally, let's talk risks and headwinds.
Because obviously no high-margin business is totally immune to global headwinds. We have to impartially consider these vulnerabilities. First, there's intense global scrutiny around health concerns and looming sugar taxes. Second, currency volatility. Since Coke operates in over 200 countries but reports in US dollars, a strong dollar can really mask local growth. Third, there's that massive bottler dependency. If the bottlers struggle financially, the parent company struggles right alongside them. And finally, governments worldwide are pushing strict packaging and plastic waste regulations.
But look at how they defend against those health concerns. Their zero sugar innovation is pulling serious weight. In the first quarter of 2026, while overall volume grew 3%, their zero sugar portfolio surged by 13%. They're aggressively pivoting to ensure that even as consumer tastes shift away from calories, the actual habit of buying a Coca-Cola remains completely intact.
So I'll leave you with this final provocative thought to consider. Can Coca-Cola keep selling the invisible high-margin core while the system handles the heavy physical work? As long as they can answer yes to that question, the concentrate money printer is going to keep on running. The entire investment thesis hinges on this single dynamic. If they can command a premium for their IP while partners manage the local factories and trucks, they will remain a true masterclass in asset-light consumer capitalism. Thank you so much for joining this explainer.